Covered bonds are the hot topic around the water cooler at the moment, and we're now hearing Westpac has issued a $3 billion paper. It's 10 basis points lower than CBA, and to talk through the details, we're joined by Todd from FIIG Securities. Mark, what generated this lower spread that we saw for Westpac?
Okay, good morning. It is, I think it's around the education piece to some extent. The CBA did well in bringing the market, the covered bond, the first issue in the Aussie dollar, so that brought a lot of response, and the market rallied well after that. So there was the first Aussie issue, CBA was slightly higher, the market rallied down in trading into that 160, 165 range, and so Westpac were fortunate they could take advantage of that that level of demand to come out quite quickly, and so we haven't seen any movement in terms of that spread from CBA, so they were able to print the same price but slightly better with 10 basis points.
Are we likely to see some more of these covered bonds issued in the near future?
I think, Kate, while we hear all the banks talking about the difficulties around the wholesale funding, they'll be looking to take advantage of the covered bond market. Remember, there is only a percentage of their book that they can issue, so they'll take advantage of it while that money is available. We see Europe continuing to be difficult, so it would make sense that they would be having all the lawyers, all the analysts, everyone trying to put together a covered bond issue that'll come to the market in some way, shape or form.
Right, and what effect is this having on the secondary market and on bond investors?
Well, to be honest, it's very interesting. Normally you would think there'd be the crowding out effect, where at the moment we've seen a bit over $6 billion trade in a week. It's been the opposite. It's brought a lot of attention to the bond market, where people are saying they like the look of the return at 160 to 170 for very safe and secure paper. But conversely, it's bringing to their ideas that they can take senior unsecured at the 190, the 200 range over, and if it's AAA for Westpac at 160, and you can pick up another 40 to 50 basis points for their next level in the capital structure, senior unsecured, that's a really great return. So we've actually seen a lot of activity around people switching into senior paper. And
will the bond market likely outperform equities this year? What do you think?
It completely destroyed the equity market performance in 2011. I can't see that change in 2012. When you look at the equity performance, I think if they're really, really happy, they'll get 3 to 4 to 5% return on average. We have to look at the averages. The bond market itself, you'd comfortably get, if you were a hold to maturity client, you'd get that 6 to 7% return. Discount the fact that credit spreads are moving. We're seeing some of the credit spreads in the US senior paper rally dramatically, so you're seeing people getting that 20% return just in the governments, not to mention the inflation-linked bonds and the senior paper. You could comfortably get 6 to 7, but if you're a credit trader, you'd be expecting a little bit higher than that, I could assure you.
And Mark, CPI numbers due out today. I just want to get your take on them. Expectations seem to centre around 0.2%. What's your view? Yeah,
I think most people are saying that's 0.2. It'll be hard to go outside of that. I think the really important piece is the segmentation. We talk about 2-speed, 3-speed economy, and Deloitte spoke about it yesterday. It's just that idea that there is a multi-speed economy, but there is also a multi-state economy. So if it comes in at 0.2 and
0.2 headline,
0.2 in the quarter. So if, so if it comes out of 0.2, but you see real strength in Western Australia and real weakness in New South Wales, that'll affect the RBA's view on where they want to put cash rates. So it's not just that headline number at 0.2, it's how it's dispersed across the country.
Todd from FIIG Securities, thanks so much for your take on that.
Take care, Kate.